So I think I'll start with the introduction. One of our panelists is joining in. So I think it's a 40 minutes power-packed session, all about M&A and private equity in the new economy space. And with India's story in the new economy, it's a completely practice area which has the traction of all the stakeholders, from the regulators to the private industry, and I would add, since there was a session, even of foreign law firms, because what they're looking for is for the advisory piece of the business, and M&A private equity comes at the helm. We have a very esteemed panel, and they've led some of the leading deals and been part of it, and therefore we will cover a variety of topics. Now the benefit of this panel is also that we are able to cover both M&A and private equity. So the M&A we'll be covering that aspect, and private equity will be both listed and unlisted. We all know that there's around $3.2 trillion of dry powder lying globally as private money. Now, how India could capture that is a huge question at the policy makers and including the deals which we are dealing. And at the time when India has crossed the 100 unicorn mark and a China plus one strategy on the cards, it's opened doors for both the new economy as well as the manufacturing space. And we have CV Raghu sir, Group Legal Advisor of Motherson Group. So he has a 30 years experience in dealing with these M&As and also from a manufacturing perspective. So we'll seek his inputs there. Then we have Kaushik Mukherjee, who's President Legal Indiabulls Housing Finance. He has a good fortune of handling a lot of listed entity work, which becomes very complex because SEBI gets involved, including takeovers and hostile takeover. So I'll be taking his advantage on all that experience he has. And we have Vaibhav, Kakkar, who is the senior partner, Saraf and Partners, who's been leading some of the cutting edge deals in the new economy space. So we love to have his experience with us also in this entire panel sharing. And lastly, I think Neera has joined in. I was just introducing, please come in. So now the money panel is complete. So we have Neera also joining in. She's CEO and GC, Sistema company. And I think a unique thing which I found in our experience interacting with her is, we all come from the legal sphere, but she's a general counsel as well as a CEO. So I think she can really bring in the business perspective to the entire discussion. So I think that's the diverse panel we have. Mr. Raghu, will want to start with you. That 30 years of experience in this sphere, you have led many transactions. I think you'll be on the recipient side. There are a lot of young firms here, experienced firms also here. So you have been on the recipient side of a lot of these transactions. So I think if you could share your practical experience on the nuances of this deal, I think it will really give us a lot of insights.
Thanks for that gracious introduction. First and foremost, thanks Business World for inviting us on the panel. One thing, any number of years of experience that you have, every transaction is a new transaction. You have to start fresh. You can't say that I've done 40 transactions in my life, so the 41st transaction is something, it's a cakewalk. You have to follow. It's like, I often give this example, it's like a pilot who gets into the plane every time and he checks all the 100 switches before he starts the plane. That's how you actually cover your risk and ensure compliance. Having said that, you rightly said, I think our topic is very wide. You're talking about M&A on one side, you're talking about private equity, then you're talking about venture capital, and then you're talking about other funding arrangements, right? So that we can speak one full day on this topic, but given 40 minutes, we'll have to. Different transactions have different nuances. M&A, you don't buy a company because you want to buy a company. You buy a company if it is only complementary to your business. There will be dime a dozen companies in the market, and especially post-COVID, the market is full of companies. But you must be very clear whether what I'm trying to buy is synergetic to my business and will I be able to convert that business and integrate that into my business? If you don't have the capability to integrate that, it can become a liability and you'll drain. You'll drain substantially. You might have paid a huge amount of money. And there are a number of examples in the market where people have gone and bought companies at 5x the value, but have ended up with minus 5x the deal value. They've lost a lot of money. So M&A is that. The second part, I'm just keeping it very limited because
Absolutely.
Venture capital obviously is for startups. When you're starting up venture capitals, and venture capitalists they're more like they fund you and they are your long-term players. So they look at your business plan. So they are in a way also your kind of advisors who love your project, and therefore they are willing to partner with you in the long term. Maybe initially they give you one tranche thereafter. Coming to your P, private equity guys look at opportunity. You need the funds, they look at the opportunity, they have a lot of funds and they come in and they exit. You got to be extremely careful. I've dealt a lot of private equity, but it's one of the most expensive forms of fundraise. People don't realize, but private equity is the most expensive because you're giving away your equity instead of a debt. Where in private equity, it's not that you don't get. So you must balance what's your need, what's the purpose, and how much you want. If you don't balance all those factors, don't blindly go and take a private equity funding just because somebody is willing to fund. It must be balanced with, because as the market is very volatile right now. The interest rates are just moving northwards. There are a lot of companies in the market to be acquired, but whether all the companies will see the light of the day, nobody knows. And I can say this with hand on heart, that at any point of time, we have about 30, 40 M&A opportunities on our table, Indian and international. But our strike rate would be what? 10% on the outer side. So which means if you have 40, you do about 3 or 4 transactions at the end of the day. But you go through all the 40 transactions, you apply the full diligence on all the 40 transactions, and you see, and the 3-4 parameters that I mentioned, you actually map them. And also map it with your culture. Your organization has a different culture. Not every company, a company that's been managed by a private equity, you suddenly bring it into a promoter company, it won't work. Because just give you a simple example. The salary structure per se of the acquiring company will be very distinctively different from your salary structure. Now, you don't buy just machines. When you acquire a company, you acquire people as well. So, if you buy one set of people who are culturally different from the other set, you have to spend huge amount of time and energy to bring about that synergy and bring them into the family. So, you'll have to weigh all these considerations. One last point. This is not a glamour world. I just want, if there are young lawyers here, private equity, M&A, and venture capital funding and fundraising. People think this is very glamour when you're in law school. It is not. It's one of the most serious, tenacious, time-consuming, and extremely stressful transactions, because where you actually go for the yes or no is a very sensitive, critical decision that you have to take. And as lawyer, you have to advise the company why you should not do it or why you should do it. So it's not fun. If you're serious, be in that space. If you're not serious, don't be in that space. Thank you.
Thanks a lot, sir. I think this has given us a lot of insights, and I come back to, I have some follow-ups, and I think we have the benefit of sharing. But Kaushik will like to take your advantage. And especially, in the new economy, we had 100 unicorns. And I was talking to one of my VC clients. He was saying soon we'll have a separate index for the new economy companies. But the problem which is coming is a lot of loss-making companies are getting listed as on date. And even the policy makers are looking at, a systematic risk issue. Now, you've had the good fortune and a lot of experience in that. If you could give your inputs on those aspects, that how do you see SEBI reacting and the IPO policy, I think that will be very beneficial.
Sure. So, hi everyone, and good evening, and thank you guys for getting me on this panel, and thanks to BW World. So yes, Varun, you've sort of touched upon a very important discussion these days, especially in this new tech companies, new age companies, startups coming up, and of course, the most important thing in the life cycle of a PE or a VC or even a lower down sort of investment is the exit. See, the first thing that you should plan for when you're coming in for the investment is the exit. And Vaibhav will tell you, he does a lot of these transactions. He will tell you that the exit is often built into the agreements itself. So, needless to say, one of the most popular forms of exit is an IPO. But you know what happens when a PE investor comes in and spends a bit of time, takes it to IPO, and then sells out. PE VC investor sells out, or even if it's any other kind of shareholder, you can actually exit. You could exit the company fully upon listing. But I guess the recent trend has been, and so what is happening is when you exit, you're naturally, it is a public market deal, so you are selling shares to the public. And if within a few months the share price tanks, obviously you have a problem in your hands, because it is these public shareholders that are actually losing value, and SEBI's only or rather its primary work is to protect the public shareholders. So I guess one of the things that we've seen recently is, so what you could do in IPO companies which were loss-making, which didn't have the track record that it was required, is that you could, if you sold a certain percentage of the IPO to Quibs, for instance, you could still go ahead without that track record. However, one of the moves that SEBI has recently announced is that you cannot sell out fully in such circumstances. So if you hold a certain percentage of the shareholding, then you can only sell out 50%. If you hold lesser than that, then again there is a limitation on the number of shares that you can sell in that public markets exit. So and the rest of your shareholding is locked up for a period of 6 months thereafter. So it sort of reflects a bit of a skin in the game, that you're not selling out and leaving whole hog based on valuations of a stock that has never really been in the market. So you don't really know what the market forces are, whether it'll go down, it'll come up. So I think this is one way in which SEBI has recently sort of changed the game a little bit. So two schools of thoughts, if you really want to analyze this. One school which says that let the markets find their own. Why are you intervening here as a regulator? Why markets will find, if a stock has to lose value, it may for a diverse amount of reasons. It may be the global economy, for all you know. Why are you then trying to put a fetter in the amount that can be sold? Of course, the other part is the whole aspect of protecting the public, which I spoke about. So it's a debate. I mean, it's for you guys to judge what the right answer is, but as of now, that's where we are.
Thanks a lot, Kaushik. But any kind of policy inputs you have on addressing the loss-making issues? Would you want to?
See,
any suggestions you may have?
I certainly think that, of course, I've been doing this work for many years and in diverse jurisdictions. And what we see these days is, so when would a company achieve listing? It was upon a certain amount of maturity in its life cycle as a corporation. However, nowadays we are actually finding companies that use this as a means of fundraising rather than hitting the public markets when you've evolved to that extent.
Absolutely.
So I think while people can make some special laws in relation to, so in the US there are special laws in relation to listing of fintech companies, of new age tech companies, and maybe that is something on a policy wise we can actually indeed look at that.
So I was talking to one of the new age companies got listed. I think just an input on that. Their defense to this is that when we are getting listed on loss making, 90% of the money is coming through institutional capital. And they are not fools who are putting money behind us. So I think there's a bit of dichotomy there, which we'll need to solve it from a policy point of view.
I completely agree. It is certainly a dichotomy. It is when you have the backing of sophisticated investors, quibs, which is what Varun is talking about, then clearly they are supposed to do their own diligence to a certain extent. Also, the disclosure for IPOs is the principle is all that is required for somebody to make a well-informed investment decision should be out there anyway. And you've made, solid set of rules towards that. Now, why then would you try and curb and put in fetters in a way that a fund would normally exit? So I completely agree, and that is something that, even if you have to regulate, at times I've seen that people tend to over-regulate. So there has to be a line. You need to draw a line, and I believe that a lot of thought should be put in before we actually curb exits, it might fall, detract people from investing if you didn't have a clear exit in mind and a clear way to exit in mind. So yes, I'm with you, Varun, as far as that is concerned.
Thank you. Thanks a lot. Vaibhav, now with you, we have the benefit of getting insights on some leading new economy deals which you have been leading. I think feel free to address any specifics which you have in mind, because we love the audience to have your experience. But I had some specific 2 points from my side. And I think specifically in the recent news, corporate governance has become a huge concern, and especially with the Bajaj auditor resigning right now and MCA issuing a circular that if you resign, the auditor liability doesn't go out. So I think in the new economy says that's a huge one. Secondly, how do you see, because I think you have the benefit of a lot of advisory lawyers don't have the benefit of enforcing those contracts. And I think you have a dual expertise there. Now, how do you see these investor rights getting how quick in being enforced in India? Because a lot of investors are raising those questions, right? You prefer foreign jurisdictions or India. So I think investor rights enforcement of these contracts, which we do, and corporate governance for some big tickets in the new economies, and any other which you may want to pick up.
Hey, thanks, Varun. It's a great question. Good evening, everyone. It's a pleasure to be here. First of all, I think I couldn't agree more with what Raghu sir and Kaushik have said. To begin with, we're in a very interesting play at the moment. You and I sparred a couple of weeks back about how well India is growing as an economy, and we will very soon become the third largest economy in the world, and all the macroeconomic indicators are looking awesome. But in the same breath, I think my point of view is, and we are addressing here the overall general counsel community. And while overall the mantra of the government is ease of doing business, but hand on heart, if you were to have discrete conversations with each of my friends here, they'll all tell you doing business is becoming challenging by the day. I think what's happening is that the government is, of course, walking the talk when they're decriminalizing various company law offenses and so on and so forth. But if you look at sectoral regulators, whether it's the IRDA, whether it's SEBI, whether it's the Reserve Bank of India, you're seeing them become far more reactive. So, I will come to deal making in a moment, but I think doing business, because what has also happened is that as we have become smarter, so have our regulators. They're far more reactive. They pick up media inferences. They pick up how they're being judged in the media. They're far more sensitive to media criticism than they were before. And so over the last 6 months, just look at what's happened by SEBI 2 weeks back. SEBI has overhauled the entire LODR regulations and practically made listed companies' compliances burden almost incredible in terms of being able to comply on a periodic basis. For instance, one particular changes, and this, by the way, is a standard which is not followed in anywhere, in any part of the world, that every listed company is required to monitor all news and rumors about itself in mainstream media. And whenever there is a rumor about them, they have to either confirm, deny, or verify the rumor. Now, nowhere in the world is this a standard. I've evaluated this. Even in the US, only if a listed company has reported something and it creates rumor, it creates market speculation, is the company required to disclose. But here, what's happened now is that they're saying you not only verify your own source, any third-party source talking about a news, about a deal, needs to be now either verified or confirmed. So as a result, there are so many times, Raghu sir will tell you that and so would Kaushik, that there are so many times that you're in a competitive bidding position. Now, you obviously don't want the market to know that you're in the verge of closing a deal. And no deal is done until you've actually signed the dotted line. Now, imagine the extent of compliance burden that SEBI has increased overnight. The other point is that the minorities become the new majority. Earlier, only related party transactions required majority of minority approval. Now they're saying even non-related party transactions requires majority of minority, leading to the credence that minority is the new majority. So what we are seeing now as a trend, one is the M&A part of it, and I'll address it in a moment. I think overall for all the general counsels here, the businesses are going to be a little more challenging because the regulatory environment is far more reactive. Whether it's food delivery platforms, you're seeing FSSAI come down heavily on them. And look at liability, look at Copra, the kind of changes they've done. On one hand, they tell e-commerce marketplaces, you're only supposed to act as a facilitator. But in the same breath, they're saying you have to give warranty on all the products that are sold by sellers on your platform. Look at the dichotomy there. So you're seeing on Copra, FSSAI for food delivery platforms. Look at fintech. There was a bit of an arbitrage, one would argue, regulatory arbitrage. There was a gray area. Businesses were exploring that with all those prepaid wallets and credit cards in a very different form. That business has been completely shut down by the RBI over the last few months. Look at the kind of regulatory changes that have happened by SEBI, as I mentioned. Look at what the Competition Commission has done. So many general counsels are sitting here. The amendment to the Competition Act now means that all general counsels, forget about talking about attorney-client privilege for general counsels by law can be now asked to depose before the CCI on any investigation. So
I think you will want to add the digital competition bill is
that's also pending.
That's
all I'm saying is that, look, deal making is great, but all of this will have its impact. And overall, regulators becoming smarter, very quick to act. They look at one bad example, they want to set the rule right, and then sometimes they do end up throwing the baby out of the bathwater. So that is a bit of a regulatory environment I did want to talk about. The other piece is, of course, M&A activity. I think what we are seeing now is that there's definitely a bit of a slowdown. I'll actually bucket into two parts, right? One is venture capital and private equity money. I think we're seeing lesser number of term sheets. I think there's a greater emphasis on profitability, or at least a path to profitability. Gone are those days 2 years, 3 years back where you just had a business idea and there were 20 term sheets floating around. That ain't happening anymore. Even if you don't have profitability, a path to profitability is critical. Because I think a lot of people did get inspired by the US market and, looked at the stories of Facebook and Amazon, which till date is not profitable. But there, I think the capital and the appetite for risk is much, much more. I think India has its own limitations. And somewhere, I think blind copying the US economy, I think, is where the challenge was. I think regulators have also realized that. So look at all the tech companies which are looking at doing IPOs. I think the path to profitability is a very, very, very strong demand of the regulators. And you have to leave some money on the table. I think that's what SEBI is also telling all the tech companies and the private equity and the VC. You want an exit through an IPO? Leave some money on the table for the public shareholders. Otherwise, we will come after you. So there is that environment where path to profitability is becoming critical. So therefore, as Raghu sir was explaining, for every 40 deals he sort of thinks about doing, maybe 4 get converted. On the VC side as well, I think that's my overall sort of sense as well, that I think the strike rate would be 1 divided by 10. But M&A, strategic M&A, I think is continuing unabated. I think capital markets I think maybe the next 2 months is when IPOs will continue hitting the markets, because I think then there will be a bit of a temporary slowdown until the general elections next year. But strategic M&A is still continuing. So for tactical reasons, for strategic reasons, if one business wants to acquire another, whether it's vertical or horizontal, that is going on in a big way. And deals of that nature are not sort of seeing any limitations. But VC and private equity, I think the strike rate is much lesser than it was maybe 2 years back. Also because the US interest rates have gone up, so they have other economies and other jurisdictions to invest money. You add the depreciating rupee to it, it creates a lot of complication. One last point, I think I do want to touch upon, you did ask me the question. I think enforceability of contracts is getting better. And it is a nightmare for any corporate lawyer to see his or her drafted contracts to play out in arbitration, but that is happening a lot more. I think many more indemnity claims are playing out in before arbitral tribunals, Section 9 protection against promoters and founders. So that all is playing out really well. But what actually complicates the entire environment is the fact that with each disastrous story of a tech company or a newbie not doing too well, there are allegations of financial mismanagement and financial impropriety. And that inevitably welcomes the doors for regulators such as the SFIO and the ED to also show up. And I think that is becoming also a very important and unfortunate trend where I think there has to be a distinction made. It's okay for businesses to fail. And there is no difficulty if a business fails. In fact, US celebrates failures. I think we need to celebrate failures as well. But the challenge here now is that there's an environment where if your business has failed, it takes all it takes is one rumor for the SFIO and the ED to show up that has there been a financial impropriety. I think we're being trigger happy a bit much. And, the name that you took, the latest report is that the SFIO has instituted an investigation as well.
Absolutely.
So it is muddling the waters. I think Indian economy over the last 15 years grew in spite of the government. I just hope that the government continues in an enabling environment and the message goes to the regulators as well, where they are enabling the environment, not throwing the baby out of the bathwater.
Thanks a lot. I think, thanks a lot for explaining this. Although I personally remain a very positive advocate of the India story. And I think Vaibhav and me have our difference of opinion there, but we'll come there. I think I'll take Sir's input also, but I'll just come after Neera. So Neera, I think with you on the panel, I think you have the unique distinction of knowing both the legal and the business side very well. So I think if you could, because what I was starting with is $3.2 trillion of PE money, private equity money, trying to enter India. India is going for 6.5%. Now, a lot of people say we use PE and VC in one word, whereas if you see the background of these funds and when you structure them, they're very different. Now, if you could just give us your know-how on that, it would be really helpful.
Yeah, that's right. Thanks, Varun, for this question. And thank you, Business World, for inviting me for this panel. And I would say, first, Raghu has said that, people get into they wanted a funding and they just give away their shareholdings on just throwaway prices, just because they want funding. Because I always tell my friends who are doing the startups or anybody who comes up to me and ask I am on the entrepreneurship and I want a funding and what are the guidelines and what, I always tell each and everyone, they are doing your due diligence, you should also do the due diligence from whom you are taking the funding. What has been their track record. That is not a market practice, but they should do that. If you are getting if you can get for a particular deal, a bank loan, that is much better than giving away your stake in any company. And secondly, coming down to your point, PE is basically VC, I will say, is a part of PE. VC is venture capitalists, they just temporary funding, or they just initial seed funding, or say round 1 or round 2. Whereas the PE, they mostly invest in the well-established companies where they see a value and they think that they can do some more value add to that business and then they sell it off. So mostly the PEs are they go through the way of IPOs. It is basically a pre-IPO placements also. PE also comes there are a lot of now vehicles in the market where you can invest in the pre-IPO things, and there are a lot of PE funds available in the market through which you can invest in those companies who are doing well. And I would say 10 years back, people used to list the companies because they want to have a better corporate governance. But now everybody is in the race of money, so they think that once the IPO will come, we will exit with the 10x, 20x, 50x, 100x. But how they will do it, that is a different story. And at the same time, I would say it is a lot of people talk about ease of doing business, but we do need a ease of exiting business also. foreign investor coming in India, investing in a company, their investment is 10x, 20x. They want to exit, but how to take money out of India? That is a big challenge for anybody. There are so many regulations. They're like, you can invest in India, but no investor can ignore India due to its demographics. And they have to be present in the market. There is so like huge consumer bases here. The population, so much of population is there, so they can't ignore it. But at the same time, somewhere in the back of their mind, they do have a worry of how to take back the money. So that are the few things. Like I think the PE and venture capital people do think over, and the venture capitalists, like they invest in startups. They are saying that if they have invested in 10 startups, if 1 or 2 will go well, so they will earn their money.
Thank
So
you.
I
Thanks a
think
lot.
that is more on the business
I think you
part.
disclosed the business model of VCs today, huh? So I think you needed 10x, So I think that's helpful. Sir, coming back to you, doing a quick round 2, I think we have 10 minutes to go. So I think, sir, with you, I think with you on the table, I think one thing we can, with your experience, one of the policy, geopolitically, the situation right now is China plus one strategy globally is on the highest of policy tables. Now, when that is one of the highest priorities and huge money is waiting to enter India, we really wanted your perspective, because when we talk about the new economy, earlier it was only tech. But this, with China plus one, it's opening up the manufacturing space as well. And I think you are at the helm of this. If you could just give your inputs, it would be really helpful, and how we could leverage it.
First and foremost, I echo your sentiment that India shining, the India story, real story.
Thank you.
But that comes with a caveat. The India story is not because the government is making the India story. The India story is because the entrepreneurs are making the India story. There are so many entrepreneurs, and you'll be quite surprised the kind of, we only see what happens in the cities, metros, you see the startup, you don't know what's happening in the urban and the rural. You go to the rural side, you'll be amazed about the enterprise is not always making a corporate, right? And creating a company. Enterprise is something about how people want to change their way of living life, and that's where the India story comes from. And I fully go with Vaibhav, my friend, that, knee-jerk reactions of regulators and regulators not talking to each other, trying to be one-up, will be the bane of this country. Like, as Vaibhav mentioned, and I didn't want to get into the regulations, but the recent LODR, you can't create a monster out of UPSI. They've created a monster, literal monster out of UPSI. If you go through that, and the worry for me is that it's not about creating that SDD that they're calling about some database, digital database, right? So structured digital database. My worry is that I create the database and the probability of leakage, because when you operate a company that has 180,000 employees, some tech guy is looking at it, some guy, and these are things that excite people. I'll give you an example. Suppose in Vaibhav's office, suppose they get tomorrow a client called Facebook, right? It will be the talk of the town in the law firm, right? I'm just saying, any amount Vaibhav wants to control it, there is only so much of control that you can do. Earlier, what used to happen, the strategy team, the legal team, the finance team, it used to be a core team, 5-7 people, not more than 5-7 people. And everybody was bound by huge confidentiality agreements and things like that. And people used to run projects and timely running of projects, and the moment there's a finality, you don't disclose. And your risk. But today, IRD, every regulator is trying to be one up. IRD believes that they are a little superior to RBI. RBI believes that we are the supreme regulators. So every regulator is thinking that way. And they're not looking at, if they spike one thing, it will have a cascading effect on 5 other things. That's the challenge. Actually, I fully echo that it's becoming for general counsels, it will become more and more difficult as the days go by. And at some point in time, thanks to the authors of Company Law 2013, general counsels are not KMPs, but over a period of time, general counsels will become so liable for various things that you got to be really wary and watchful of that. Coming back to the China One strategy, there's more hype being created than reality. China has its own challenges, but don't underestimate. I've been to China several times. We are not comparable at all in our manufacturing capabilities vis-a-vis China. We cannot. Let's understand this very clearly. What we take 10 days to do, they can do it in 10 hours. They are masters of creating miniatures. We have a lot of business in China. China is a big market, much bigger than our market. Like they have most of their automotive industry is there inbuilt. Like in India, you have a lot of foreign brands like Daimler or BMW, but they have their own cars, they have their own buses, and world class, by the way. They're not of any lower class. So there will be political issues for which some investors may not want to go to China, may want to look at India, but India has to really up their capability, up their competence to really get that investment here. So if somebody believes that there is a political clash between some two nations, China and somebody, that money will come, that's not a story. Yes, you have to stand on your own feet, build your competence, build your capabilities, build your... the biggest worry that any foreign company has is to come to India is that the huge amount of bureaucracy, there's no clarity on anything. They come with a very weary mind. If you can't sit in say London and ask, what are the 5 things that I need to do before I can start a factory? Ask Vaibhav, you must be having so many clients. When you say you can do this, but you'll have to think of this. The moment the but comes, that means you can't do it. I'm just telling you simple, because the guy who's investing, he'll say, why do I go to India and go through all the buts? Right? I would rather keep it somewhere else. But world is changing. Things are happening. Things will happen. I'm quite optimistic about it because we've seen the last 30 years, the revolutionary change that has happened. And in the next 30 years, it will happen. But surely the government has to hear the entrepreneurs. Failure of a business, you take a lot of decisions. Sometimes you take the wrong decision and therefore it fails. That is not financial corruption, right? That is not, managers and corporates, large multinationals make mistakes. There are ad campaigns that go on for hundreds and 200 crores and those products fail. They are not held accountable. Why should a promoter be? We have this notion, very narrative notion that a promoter makes money through all devious means, right? That is not true. It's the promoters like Tata's who made it big. It's the Reliance that made it big. There are many other promoters who are making it big, and they're doing it because they are good entrepreneurs. As simple as that. Nobody gets up in the morning to say, I'm going to steal, for God's sake.
You want to plug in?
I just want to add on the regulation part, which Raghu has touched upon. The actual problem I feel like most of the GCs also face, the regulator issue they just issue the regulation without testing waters. Once they issue, then they start thinking how to implement it. And we don't know what to do. Like there are certain things which is like just next to impossible. You can't do the business like that. So that is the key issue. I think for the last 2, 3, 5 years, maybe, like this is the key issue. First they issue the regulation, then they start thinking that how to implement it. Is it right or wrong, good or bad? That thinking goes afterwards. First, they need to see like all these things, what they do later on.
So nobody is doing the impact analysis, as they say, while passing the law. So I'll come to you. You want to step in on this?
No, why don't you carry on with your question?
Yeah, so I think it's 5 minutes, right? So I'm going to come to the last one on... Yeah. So Kaushik, I think, we've touched, so it's a huge topic, M&A, private equity. Now we've touched on the acquisition part and the investment parts. Love to have your inputs on the merger side. which is the scheme of amalgamations, right? And especially in the listed entity context, a lot of schemes of amalgamations, regulatory approvals is a huge issues which some of our clients are facing. And I think you've dealt a lot. I think we'd love to have your inputs on that.
So what typically, I'll be really quick. I'm mindful of the time, and Vaibhav also, I think, has another one. So I'll be very quick on this. So one of the things that usually happens in listed company mergers is control and how control is passing. Does it continue to remain with the listed company? Is somebody new coming in? In that case, how will the company function while the merger is taking place? The merger is an exempt takeover transaction. So generally what happens is if there's a new guy coming in, and that assuming that company is unlisted, and at the end of the process, the unlisted company acquires control over the listed company. Of course, it's a takeover exempt transaction. So people reconstitute boards, people put plans in place. The company is in a state of suspension as far as business is concerned. So a lot of these things are actually decided upfront in a merger agreement, in a merger cooperation agreement, merger control agreement. These have various names. They're one and the same. But basically, it is how the control is passing, how the company will be managed. And so the company pre the merger and during the merger is a very different company. Now, in such cases, if you have the regulator coming in and saying, recently we've seen an example where they've banned the person who was supposed to be the MD. Now, what do you do in such a situation? Because there is an agreement, there is a way that the control is passed, there is a person who's going to be the chief operating officer or the MD or whatever, the main guy who's going to head the show, and then you say that, either the merger is not going to go through for ABC reasons, or you say that, so-and-so person is part of the merger cooperation agreement, was supposed to actually step in and take that position and now can't take that anymore. Now, what do you do in such a state? So, it remains to be seen, but I think that some sort of pre-approval, etc. should happen, because it is the death of a company in a situation like this, because it can neither go forward nor can it go backwards. So that is one of the challenges that we are facing now. And quickly, another thing on the rumor part and trying to answer for that. Now, we've also seen a decent example now in which a research report actually, so somebody purchased options and then came up with a report, shorted the equity shares of that company, and actually came up with a report which resulted in actually the stock price sliding. Now, I know that research laws, we've seen that from the very beginning. There has to be clear Chinese walls. There is a conflict. There is an inherent conflict. So how are you going to deal with these situations? You ask the listed company to come up and justify the rumors, or are you going to check for the rumors itself? Because is that not a FUTP if it is actually resulting in a slide in the share value? So these are all of these things we need to think about. And I'm not going to take up any more time on this, but Vaibhav, you wanted to take the next one.
So I think, Vaibhav, you can give your inputs, and also I think if you could just put some light on some hostile takeovers. I think that's an angle which normally we don't cover in M&A private equity, but this recent NDTV deal has brought, there are few in India, so whether it's a black horse or any other strategy you might have applied. So if you could put some light on those kind of transactions if you're done, and the existing question.
Sure. Thanks, Varun. I think very quickly, couldn't agree more with the esteemed panelists here on some of the themes that they've spoken about. Look, there's no prizes for guessing here. I think we all are backing the India growth story. India is going to go places. We are seeing that growth play out in many different ways. The per capita income is tipped to double from here and after in the next 5 to 6 years. But my mantra is that, and look at the global trends. Whenever the economy is growing at a snail pace, corporates tend to flourish and rather do quite well. The challenges of survivability come when there's too much of growth, when there's too much of disruption. That's when businesses come into question. I mean, it's great for us as professionals, as lawyers, as a lot of work either way, whether it's IBC or whether it's private equity or M&A. But I think for all the general counsels sitting here in the room, I think life is going to be a lot more challenging in times to come. And again, I do want to make that distinction. I think the government, full marks to them in sort of pushing that narrative of ease of doing business, important in terms of, increasing the enforceability of contracts, the amendments that they carried out to the Specific Relief Act. Mr. Saraf, I think he'll address the rest of the audience later. But there were quite a few High Court judges when he did the judicial training for them who perhaps weren't even aware of the Specific Relief Act amendments that have taken place. And I know I'm saying this statement with a great degree of responsibility when I'm saying this. Apart from that, look, there have been a lot of changes in the arbitration law as well. So one is hoping that there is better enforceability of contracts. I think that will give a private equity and venture capital investors the belief that tomorrow if a promoter has given fraudulent misrepresentations, they can go after them. And equally so, if the investors are being literally bullies and are trying to sort of extort a value which wasn't there in the contract, there should be repercussions for that. There is now almost a set rule where you have your seat of arbitration outside of India and you try and do a foreign award and try and then enforce it in India. But we do know of a very large value, $500 million decree that Daiichi is still trying to enforce against Singh Brothers. So enforceability of actual decrees, getting the courts to execute decrees for investment contracts, I think that's very critical as well. And that needs to happen. So the government is, I think, doing a pretty decent job of that. My problem is with the sectoral regulators. I think the sectoral regulators have started worrying that maybe the big brother, which is the government, is overlooking them. And therefore, in a view to show as being very proactive, I think somewhere they are throwing the baby out of the bathwater. I think so. I am making that distinction between the government and the sectoral regulators. So there is this overall mantra of ease of doing business from the government, but not from the regulators. Regulators, in fact, are looking at one bad egg and then trying to sort of make an example out of it by completely changing the regulatory sphere altogether. So I think that is a big bit of a drawback at the moment. One is hoping that things change in times to come. The other point I do want to make about the startup story is that, look, ultimately, you saw SFIO go after the big four as well as the credit rating agencies after the ILFS fiasco. One thing which is very important is credibility of numbers, right? I don't want to take names, but the big tech companies that are up in media right now and they're being spoken about, I think the biggest question mark is credibility of numbers. The balance sheet and the financials that you and I are reviewing, are those numbers credible? And if you have 5 disastrous stories from here and after for the next 1 year, believe you me, that will have a bearish effect on the investors. So for one bad story which stems, again, I'm saying there's a difference between businesses flunking and bad stories where numbers credibility is a question mark. You have 5 bad stories and suddenly the whole story will start looking different. So I think for me, the sentiment is that of careful optimism. So I am optimistic, but I think there is going to be a lot more challenges for general counsels and for the external counsels as us. Great for business. But overall, I think it means that I think the road from here is going to be a lot arduous one. Coming to hostile takeovers, I think, look, we're seeing quite a few examples. I think ultimately, whatever changes have happened on the IBC side for listed companies as well as the changes on the takeover code, I think the diktat from the government and the regulators is, it is nobody's fundamental right to run businesses. If you're not doing your business well, if you're not performing, you will be thrown out. I don't want to get into specific names, but whether it was an IT company which got acquired by a large industrial behemoth through an hostile takeover a few years back, or whether it was media companies, what you're really seeing is that ultimately institutional shareholders are looking for a bang for their buck and they're looking for long-term value. And companies which are high on corporate governance are always getting a premium value for it. And so, therefore, I think I think overall the public market is rewarding good companies for good corporate governance. Wherever the governance is a big question mark, wherever there is a return question, I think promoters will lose control. And we're seeing many more examples of it. And I can confirm to you that this is a trend which will only get stronger. Promoters have to start believing that they might end up ceding control if they don't perform. So perform or perish is the mantra that the market is now strongly believing in, I think, and the regulatory framework is also enabling that. So all for it.
Thanks a lot for those inputs. So, Neera, we'll like to end with you. And I think to an extension to that, statement only. I think the root of these transactions stem from the quality of the due diligence, and I think as a person running a firm also, and I have seen the way due diligence is being handled has changed a lot. I think we'd love to have your inputs, because I think a lot of the load is getting transferred on the transactional documents. And the way we used to go right to the T kind of due diligences on some factor or the others is going out. And also I think in terms of the reports, if you could put some lights, because I see a lot of law firms, they make bulky reports, whereas a lot of GCs, what they're looking are strategic inputs. And I have seen this a lot with a lot of my conversations. So I think if you could just put some light on those.
Yeah, Varun, I will just wrap it quickly. So see, whenever any acquisitions or merger or any transaction happens, the first step is due diligence. And I know you are also running a law firm. Maybe my law firm people will get offended. What they do is they just put the associates or the interns on the due diligence process, and they don't dive deep into the documents. And then there are problems later on. The transaction documents start working on, the teams start working on the transaction agreements, and then later on, I have seen many transactions getting failed because due diligence was not done properly. And secondly, the construct of the due diligence team. It's not only about the contracts, it's about the litigation also. It's about the arbitration. The people who are going to the civil courts, maybe they are not that vigilant on the arbitration. So what kind of litigation that company is having? Are you looking into what kind of lawyers they have hired? What's the stage of the arbitration? What is the stage in the civil suit? All these things matters a lot when you are acquiring or merging any business. All these liabilities come out once the transactions are done, because there are some loopholes which are left open during the due diligence. I feel like I always say that it is very easy to make the data rooms, but to make that work and what is the end product of that data room is very critical. And we many times we are in so much hurry, and the people who are working on the deal, they just want to close the deal. They don't want to see there are difficulties or there could be no also. Nobody wants to listen. No, see, boss, these are the red flags. Nobody wants to listen to that. So that is I think that is a very important part, and it should be very crisp. The report should be very crisp. Making a disclosure letter lengthy is not going to serve.
I think that's a great one.
I have a question for the three general counsels here. How many deals, or how much easier is it for you in today's times to actually call off a deal on account of red flags, which are purely legal in nature? Do you get a lot of pushback from the business, or is it now a lot more acceptable to be actually saying no to a deal because there are red flags?
So I think we also have a red flag from there. So I think, sir, we'll conclude with you. Yeah.
It depends on the personality. In my 30 years, if I have said no, the business has never questioned me. So the question is that you have to go back to the business with the courage of conviction and with valid reasons. At the end of the day, if you are saying no, you must have sound reasons to say why you are saying, why a red flag is dangerous for you. But I agree to what Neera was saying, is that don't be in a hurry when you're doing the diligence. Make sure that you do the diligence in a proper manner. And it's a learning for us, it's a learning for the law firms. If the diligence is not meeting what you expect the diligence to meet, then ask the law firms to redo it. It's not about being in a hurry. The moment you set a time and say that, there's a huge data room, but do it in 15 days, humanly not possible sometimes. So you have to give the time and you have to be engaged. I have always seen that the more the general counsels are engaged on transaction, the better has been the outcome. Because you must tell your counsel what you are looking, the counsel, there has to be a chemistry that has to work between you and your external counsel, because both of you are complementary to each other. It is not just, you just don't hire counsels because you pay them money. No. It as a collective team, it has to work. And if that understanding is not clear, the deals will fail.
Understood. I think thanks a lot, sir. To conclude, I think we have had a lot of colors on the practice area, from M&A to private equity to takeovers. And I think to conclude, I think we have diverse views also here. To conclude, I'm still an eternal optimist of the India story. $3.2 trillion, India growing at 6.5. I think it's going to be unprecedented growth. We are traveling a journey from $3 trillion to $10 trillion. Apple enters with a $3 trillion on base this year. So I think it's huge, but I think there's a lot of critical inputs come from the other side of the panel also, the regulatory inputs, and that we need to look into to get the big dollar in, as they say. And I think thanks a lot, everyone. Your experience really counted for making this very fruitful. Thanks a lot.